How to Roll Your IRA, 401k, or 403b into an Annuity by Jennifer Lang Financial Services. Rolling over some of your retirement savings into an annuity, which will eventually provide guaranteed, secure lifetime income, can be the answer to a lot of questions and concerns you have about supporting yourself after you've retired. With the demise of pensions for most workers, many have found themselves on their own to chart out their retirement finances. The big question they face is, how do they do it? Imagine you've built up a sizable retirement savings in your employer-sponsored retirement plan or your own IRA account, and you're getting ready to retire. But without a pension, how do you make sure you have continuous income to fund your retirement years? Social Security won't cut it. It's too little, and who knows how long it will be there. How do you use your savings to fund your retirement? How much can you withdraw at a time? How do you know how long you'll need the money to last? What if you run out of money? What if you spend too little because you're afraid of running out of money? In other words, how can you make the funds in your 401k or IRA more like a pension? One popular option is to use a portion of the funds to purchase an annuity, which will provide you a stream of income like a pension. The income can be structured to last the rest of your lifetime, or, if you are married, for 2 lifetimes. And if you don't want lifetime income, you can create an income that lasts for a set period of time, 15 years, for example. A licensed financial professional can help you build a plan that is right for you. Say you're interested in using your retirement funds to buy an annuity. Should you withdraw the funds from your retirement account, pay the taxes, and then buy the annuity? Or can you just roll over the funds directly into the annuity, continuing to avoid taxes until you receive the income stream payments? In most cases, the Internal Revenue Service allows qualified funds to be transferred into or out of qualified annuities. Direct rollovers occur when qualified funds move from one trustee to another trustee without touching the owner. Under these circumstances, direct transfers are tax-free. Direct transfers are commonly done by mailing or wiring funds directly to the new plan provider, but on some occasions the old plan provider may mail the check directly to you, payable to the new plan provider. This still counts as a tax-free direct transfer. Indirect rollovers, however, are more complicated and have significant tax consequences if not executed correctly. Indirect rollovers occur when the participant takes constructive receipt of the funds. In order to remain tax-free, the funds must be rolled over within 60 days of distribution. Otherwise, the distribution is income taxable and may also be subject to the penalty for withdrawing funds prior to age 59 and a half. Indirect rollovers have other consequences as well. Distributions made from qualified retirement plans, such as 403b annuities and 457 plans, are subject to automatic withholding tax in the amount of 20%. Internal Revenue Code considers the withholding a distribution unless it is added to the 80% received and reallocated during the 60-day limit. The advice here is simple: whenever possible, use direct transfers. A 401k is an employer-sponsored retirement savings plan that allows employees to save pre-tax money from their paychecks, often with a partial match from their employers. Money deposited into 401k accounts is not taxed until it is withdrawn. It gets its name from the section of the tax code that covers it. By and large, 401k plans, known as defined contribution plans, have taken the place of pensions, known as defined benefit plans. 401ks are the primary vehicle of employer-sponsored retirement savings. An IRA is an individual retirement account in which the saver directly deposits pre-tax funds. Often, individuals who leave companies where they had 401k plans will roll the funds from them into IRAs. Regardless of whether you own a 401k or an IRA, once a distribution is taken, it is taxable as ordinary income. Additionally, if you are withdrawing money prior to the age of 59 and a half, then the IRS levies an additional 10% penalty tax. The same rules of taxation apply when you roll a 401k plan or an IRA into an annuity. Here's a quick recap. Despite the fact that a 401k is one of the most common employer-sponsored retirement plans, Many employees may not fully understand their options for accessing or moving their money when they retire or leave their current company. One option is to simply take the cash. If you do, however, you will be subject to appropriate income taxes. And if you are under 59.5 years old, you will be subject to a 10% withdrawal penalty and possibly even a 20% federal withholding tax. Because of the potential penalties and tax implications, this is usually not the most favorable decision. Option 2 is to just leave the money in the 401k. Your employer is obligated to allow you to do this, and if you go to a new employer, you even have the option to transfer the money into the new employer's 401k plan. Option 3 is rolling the money into an IRA. There are a wide variety of IRA investment choices, and you can select the one you like best, rather than being tied to the options that were available with your 401k. Option 4 is rolling the money into a fixed annuity. Many individuals appreciate this option because they can protect their principal from market losses, provide tax advantages similar to an IRA or Roth IRA, allow guaranteed retirement income for life, and even provide a potential death benefit for their family. Retirement and 401k management can be confusing, so we invite you to contact us and schedule a complimentary consultation. We will review your options and assist you in making the right decision for your future. Determining how much of your retirement savings should be in an annuity should start with an analysis of your routine expenses. Ideally, you should make sure you have a guaranteed income stream to fund at least 80% of your budget. This income stream can come from Social Security, a pension, or annuities. When you consider rolling your retirement savings into an annuity, you should be familiar with the types of annuities and the benefits and drawbacks of each. Fixed annuities are less costly to the purchaser and more reliable as far as an income stream. You should consult a licensed financial professional to help you determine how much of your retirement savings should be used to purchase an annuity. A financial professional can help you determine what type of annuity works best for you and whether you should purchase specific riders to modify the contract to meet your needs. You could also use various strategies, such as annuity laddering, which takes advantage of different types of annuities to construct the income stream you need, or a split-funded annuity, which enables you to get the best of different types of annuities. Another possible strategy is to delay receiving the annuity income stream as long as possible. That's because your expected lifespan is part of the calculation an annuity provider uses to determine how big your payments will be. The shorter your life is projected to last, the higher the individual payments. Consequently, the older you are when you begin receiving payments, the higher the income payments will be. There are a number of strategies you can use to manage your financial future. You need a knowledgeable financial professional in place. And that's where Jennifer Lang Financial Services comes in. We work with over 20 of the best A-rated carriers. We can do the work for you to get the best rate and benefits for your individual needs and budget. Take advantage of our complimentary consultation today. We can help you put together a tax-deferred strategy to maximize Social Security, prepare for long-term care costs, and provide you with options for guaranteed lifetime income. Visit us online today at jenniferlangfinancialservices.com. Thank you for attending. Stay safe.